Hi, this is Tim with ATP Healthcare, and we got another video here for you. This is about the interesting year that uh, DaVita has had, or at least an interesting year and a half, and kind of go over some of the issues, not clinical issues, but some of the financial issues that they are going through right now. That's going to make it really kind of hard for them to work with you on some of those patients that you got. So. Let's start off with DaVita over the past 5 years. 5 years ago, the stock was about $70 a share. And today it's about, well, we're going to be closing at, let me see here. Previous close was at 72, but we're going to close at about $74 today. Let's see, we have 72 here. Yeah, so 72.34 is what we're looking at. We're going to be closing at here around there. So per share, back to 5 year. We're going to see about a high, about 133, somewhere right around, yeah, there it is, 133 back on August 6, 2021. Interestingly, though, let's get to September 17th here. We had about a price of $121. And then at the end of, let's see, right here at the end of, we had a 111 right here. We have 111 there. So we went from a high about 133 down to 111 within 6 months. I kind of point to this because on December 16th, DaVita, they had some cash on hand. This was mainly due to PPE and a number of other things related to COVID. And the kind of like the consensus was that they were going to invest this, and well, outsiders looking in, some of the risk management folks were saying that, well, maybe they should go into and help support the frontline staff. DaVita decided to do the stock buyback method here, and that's not really out of their it's not out of the norm. DaVita does buy back a lot of stock. And companies in healthcare and any industry, S&P 500 are going to do that. But DaVita buys back a lot of its stock. And here we'll kind of like look at it real quickly. So September 30th is when it was reported, because that was the end of the quarter. So $338 million stock purchase. But later, $656 million. All right. So they did just about $1 billion in stock buyback. And well, over that easily in 2021. We're looking at close to $1.5 billion there. So we have multiple billions of dollars of stock buyback that they do over their history here, and that's going back all the way to 2010. Why would you buy back stock? Well, it secures the company, right? Makes it much more difficult for an outsider to buy you that you don't want them to buy you. But companies can go in and get some influence. So there's still, I believe, I think it's like about 10% or 15% of stocks are currently available now for the company, publicly traded. So the debt to equity ratio. So it's how much debt there is out there, how much equity that there is. So equity is the total number of stocks that are available that you can go out and buy, and that's going to be about $680 something million. It says here it's rounding up 0.7, and they're running at about $9 billion in debt. And so you have a debt to equity ratio of 12.63. Now, currently, the hospital that you work in, if you're a nonprofit hospital, like a religiously based hospital, you're probably going to run about a debt to equity ratio of about 2. You're going to have privately traded shares. Usually those shares are in your hospital or religious affiliation. If you are a publicly traded hospital, such as like a potentially like a Steward Healthcare or a HCA, you're going to see a debt to equity ratio of about 4, and that's fine. I mean that's on high end typically, but for a healthcare company, because the price earnings ratio for those companies are much higher than other industries, S&P 500. That's okay. I get a little bit nervous at 4, but it's all right from what we've noticed. But have a debt equity ratio around about 12, almost 13, you get really nervous, right? So if I'm a lender, I know they got money. I know that they can pay us. I mean, on some cases, because they're DaVita's running between 11 to 13 billion dollars over the past few years for revenue. It's closer to 11 now than it was than it is 13 now. 2019 is about 13 billion dollars now. It's like around 11 billion dollars revenue. So that makes me a little bit nervous, but it makes it kind of an interesting candidate for it to be purchased. And now we kind of go to their price earnings ratio. Price earnings ratio, so it's your stock and your earnings over your earnings. So that's a low number, 9.81. S&P 500, you're looking at between 20 to 25 is like your average S&P 500 company. So this is low on that standards. The average healthcare company, 48. That's your average price earnings ratio, PE, price equity, price earnings, sorry, price to earnings ratio is about 48. And so healthcare is a $6 trillion industry in the United States. Used to say 4 trillion. No, it's way more than that. It's 6 trillion. So, and what this means that that stock is considerably undervalued, right? So it's like the stock's been having its price been driven down for quite a while here. We'll look at similar companies that they have listed here. We're going to have a Quest. Everyone's familiar with Quest Diagnostics. We're in at 13, so it's undervalued. Chemed. Now, it's Chemed, 2563. That's an investment group that's publicly traded. They have two companies. One is going to be Roto-Rooter, and the other one is going to be the Flying V, DaVita's Healthcare. Right. So, and they about equally contribute to the company's revenue. So, so at 25, it's a little bit harder with a company like Chemed to judge and say, well, whether or not the stock's undervalued or valued properly. And Compass Health, we all know, we should know them or be pretty familiar with them. They have rehab hospitals and home health organizations, for the pop-up ads. And I just kind of want to go through and just get a couple more examples. Going to look at Chemed here real quick. So price earnings ratio is going to be running at 29, but and change. Currently 29 and change. And then again, we see DaVita with 9.81. It's going to be your price earnings ratio. Now, so stocks undervalued and a consideration. Now, it could be two things. It could be an investment possibility for a company. It's going to have a hard time buying it in whole, or at least having be able to sneak in there and buy it whole. Because there's not that much stock that's actually available. That the other thing is, though, it's going to be very difficult for DaVita to raise money on its own because the commercial industry has pretty much been stripped away from it. And that happened earlier this year when the Supreme Court ruled in the favor of Marquee Health. Marquee Health is a health system in Ohio, and they basically said Marquee Health was saying, well, if you are end-stage renal disease that's covered under Medicare, we're going to transition you off of our plan into the Medicare plan once you're eligible. DaVita fought this, took it to the Supreme Court, and lost. And that does that. I mean, now you're looking at act of Congress to get that changed, and we'll see. I mean, it's not impossible, but you're looking at an act of Congress to change the laws on that. Now, sorry, it was Marietta Memorial or Marietta Health, not Marquee. Marietta. Marquee is a skilled nursing provider. Now, so these patients now are going to be on Medicare. DaVita, of course, much rather, just like a hospital, would much rather have those under commercial payers. So with that reduced amount in payer, it's going to make it a little bit challenging for them to raise money. Now they're going to look to build that to make up for that. And one area where they can look to make up for that is in hospital contracts. So they'll be looking to potentially bump up or aggressively pursue hospital contracts to make up for those losses. Now, pre-COVID, they're looking at about 220,000 patients on their that they were seeing annually. Now, since COVID, we're looking at about 180,000. So we also have a loss in patients too on top of that, and even more so. Those normal type 2 diabetic patients that would feed into their system have become extremely higher clinical complexity, and that's going to also cut into their bottom line. What we see going on here, though, nothing to be changing. And with DaVita in the short term, we do see them as a potential target for a provider or organizations such as Humana, in which they may want to invest and purchase some of their outstanding shares. That would give them a stake in the company, and and essentially be able to control leakage, if you can see it in that way. So if you're on if you're managed Medicare and you're sending patients into dialysis, you'll be able to capture some potential leakage that you may have with your payer system. But we are working, in full disclosure, we are working with a dialysis provider or providers. They are working with skilled nursing providers to not just provide dialysis services in-house in the skilled nursing facilities, to also provide with outpatient dialysis. And this is skilled nursing facilities, be it that their census are rather low, is sort of an interesting match, because also those skilled nursing facilities would be able to handle patients in beds. So we are working on that mainly in skilled nursing facilities in the Southeast United States, but I know that company, one of our main companies we're working with, is looking to go to the East Coast. And so you can kind of reach out to us. We do have 2 advisors, in full disclosure, that do come to us from DaVita. They were C-suite folks on DaVita, and they've been very, very helpful in kind of discussing some of the issues that are going on. If you want to reach out to us, please click on the link onto our homepage, or just go to visit atphealthcare.com and contact us, and we'll be happy to discuss what options we can help create with your health system. All right. Hope you have a good day, and talk to you soon.